Okay. Good morning, everyone. Thanks to all of you who has dialed in and joined us this morning. On behalf of Affin Hwang Asset Management, we want to thank you for joining us. And I believe that even as we enter the new lockdown yesterday, I trust that all of you are keeping safe and keeping well. My name is Sean Kong, and I'll be your host for today. And so today we want to welcome you to our market outlook talk, which entitled Market Outlook for the second half of 2021. How far is our economic growth and recovery going to look like? How far are we in our rotation from growth to cyclicals? What about valuation and investor sentiment? Should I stay invested? Should I top up? I think these are some of the questions that we hope that we are able to share some lights. The speaker for today is none other than David Ng, our CIO, our Chief Investment Officer, as well as Deputy MD of Affin Hwang Asset Management. Well, David has joined the company since 2002, and he has been the pillar to our investment team for the past 18, 19 years. With his oversight, the growth of the company from managing a 20 million asset under management to today, just a shade under 80 billion ringgit. And a big thank you to all the supportive clients over the years. Not many of you may know, but David studied law and actually started his career in a large law firm before venturing into fund management company back in 1998. Personally, I always known David to be a humble and wise person. During his free time, he likes to read and he likes to look at markets and read financial reports. But he does have a life. Okay, David is a family man. He's a good sportsman, a good tennis player, and he absolutely loved to watch Manchester United come in second this season. For Q&A later, David will be joined by Lee Pak Seng and one of our portfolio manager in our Affin Hwang group. And Pak Seng has been with us for about 3 years, and he has more than 10 years in the industry. And talking about Q&A, there is a Q&A icon under your screen, and you can you can use the Q&A session. We could see some question coming in, and towards the end of the session, maybe the last 15-20 minutes, we will try to accommodate the question as much as we can. And of course, we are all dialing in from different places, so we try our best to make this webinar a smooth experience, but we hope that the Wi-Fi from all places will be accommodative. All right, so without further ado, I would like to pass the time to David. Over to you, David.
Thank you, Sean, and good morning to all of you. As Sean said, during this period, I hope everybody is staying safe. Thanks, Sean, for the kind but a bit lengthy introduction. I was going to introduce you as well, but suffice to say, Sean is an Arsenal supporter, so I think that sums it all. I was just saying, we'll start off with a recap of the performance of the markets for the first quarter of this year. And then after that, we'll venture into the outlook proper, where I'll break down our talk into 3 sections. The first, we'll talk about the fundamentals of the economy. The second, we'll touch on valuations. And very briefly, the third part, we will talk about the technicals. And then we'll open up for Q&A. We will touch on our strategy. We'll share with you our strategy on what we are doing with our portfolios in general. So if we could start off with slide 2. Okay, if you look at this slide, what you can see here is that equities has done reasonably well on a year-to-date basis, but bonds have lagged. And within equities, we can also see that the developed markets have done better than the rest of the world, but bonds have lagged, and bonds have lagged due to, ironically, the recovery. The global economy is recovering, and expectations of higher inflation sets in as the economies reopen. We have seen supply disruptions and sharp increases in commodities prices, leading to higher concerns over higher and sustained inflationary pressures. And as you know, as inflation rises, expectations of interest rates rising also comes into the picture, and that leads to decline in bond prices. But we will be spending a lot of time later on talking about the inflationary concerns, because I think ultimately in this environment, at this juncture, that's the most critical factor we have to address in determining how we want to position the portfolio. Moving on to the next slide, we'll start off with the fundamentals. We can see clearly on slide 4 that the global economy is recovering sharply from the pandemic-caused recession last year. The manufacturing sector is leading the way, as shown in the PMI chart in the upper panel. You can see all the lines are pointing upwards very strongly, especially in the US and in the Eurozone. And that has occurred because the demand for goods has rebounded. All of us during the lockdowns, we may not be able to go out, but we are sitting at home, we are able to order goods, we are able to buy a new car, we're able to buy a new handphone or a new laptop. So that has driven this sharp rebound in the demand for goods. In contrast, if you look at the lower panel, the services sector, which is typically associated with experiential consumption, such as dining out, travel, hospitality, gaming, as in physical gaming, that has lagged as mobility is still recovering. But what we foresee is that it is the services sector that will drive the next leg of growth as vaccinations are rolled out across the world. And talking about vaccinations, if we can move on to the next slide. Okay, here's a chart on vaccinations rollout. It's a bit small, and we can dispute about when herd immunity will be achieved. So herd immunity is considered to have been achieved when 70 to 75% of the population have either been vaccinated or have contracted COVID, right? So that's a definition of herd immunity. So we can dispute when it will be achieved in the various regions or countries, but the most important fact for us here is that people are getting vaccinated. So countries who are further along in getting their people vaccinated are able to get back to normal sooner in terms of mobility. And you can see on the left-hand side of your chart, the developed markets, of course, leading the way, and we are also seeing a corresponding increase in activity in the developed markets. In Malaysia, while headlines make for quite grim reading based on what the government has said, there is a probability that we will achieve herd immunity, and this is the base case scenario. We will achieve herd immunity by the first quarter of next year when about 75–80% of our adult population will be vaccinated. And as this happens, we expect to see the services sector underpin the recovery. Moving on to the next slide, slide 6. When investing in stock markets, we've always said that when you invest in stocks, it is always about investing in earnings, right? So one of the critical factors that we look at, one of the key data points that we track is always earnings expectations. And here you can see that earnings expectations are also pointing in the right direction across all regions. Of course, the US has led the way, but we expect to see Europe catching up soon. And Asia, much depends on the global macro environment, but we also expect that the pace of recovery in Asia, especially for some sectors, as vaccinations get rolled out, to also start to improve. So what is this chart? Let me just quickly explain a little bit about this chart. This is really the earnings expectations ratio. So anything above 1 is considered positive. So a number above 1 means that there's more upgrades than downgrades. Do bear in mind though that forecasting during such unusual times is not easy, but one can confidently take the view that after the experience of last year, earnings should clearly improve this year. However, we've also always said this, markets are forward-looking. So while the fundamentals are improving, markets have also done well. So the question we have to ask ourselves is what has been priced in? And I will run through this as we move through the rest of the slides. Moving on now to slide 7. Initially, I was hesitant. I did a talk last week and I also said the same thing. Initially, I was a bit hesitant to show this for fear that you may misinterpret this and think that markets are going to go down. That's not my intention. What we have here is called a diffusion index. In this case, it's a diffusion index of consensus GDP growth expectations. And no surprise, GDP growth expectations have been moving upwards. I say this is not a surprise because, as you know, we went through a recession in 2020. So it is only to be expected that growth would rebound strongly this year. And also that this pace of growth is not sustainable due to the base year effect. So as we move through into the second half of this year and into next year, the rate of growth would definitely decline because of base year effects. But the important thing to bear in mind is that so long as there is still growth and we are not heading into a recession, the market should be supported. Hence, as the title of this slide says, expectations of growth is high. And this would suggest that the easy money has probably been made, and investors have to be that much more selective in identifying good companies or themes, investing in the right themes or the right sectors, and at the right valuations. Right? I think that is key. Other point I would like to highlight, and this ties in with what I'm going to talk about inflation later, for those who are also invested in bonds, it also suggests, as indicated by the chart on the right, that bonds could deliver reasonable performance going forward as expectations of inflation starts to taper off. Moving on to slide 8, I wish to point out that liquidity, there's still excess liquidity. And while the growth rate of excess liquidity has come down, which again is only to be expected given the base effects from last year when central banks injected plenty of liquidity in the system, the fact is there's still excess liquidity. And we've also always said liquidity has to find a home. And based on what the Federal Reserve has been saying, it seems unlikely that they will withdraw liquidity anytime soon, because they continue to believe that inflation is transitory or temporary, and they will also be monitoring employment data, which so far in the US, if you look at employment data, it has not fully recovered. In fact, it is significantly below what it was pre-COVID. Moving on to the next slide on China, since a lot of us would have an interest in China, and China being such a dominant market in the global economy, and especially in Asia. What the slide shows here is also going to lead into what I will discuss on inflationary pressures later. For now, though, the fact is China's growth has peaked. It does not mean that there's no growth. It's just that the pace of growth will slow down. But China will continue to deliver positive GDP growth. But as investors, it means we have to adapt to the macro environment in China. One should, to my mind, one should probably reduce exposure to credit-sensitive sectors in China that benefited from the rising credit impulse that we saw in 2020. If you look at the chart on the right, the blue line, you can see that the credit impulse has started to decline. And as a result, the credit-sensitive sectors would probably struggle a little bit until we start to see a bottoming of the credit impulse. So for us, when looking at China, we are mindful of this. We are mindful of the macro and liquidity and the credit environment there. And therefore, we are training our sights and focusing on identifying ideas that are less sensitive to credit data. So examples that we have looked at and that we have started investing in would be, again, the consumption side, travel, tourism would be examples that we own. However, we don't expect China to embark on any major policy shift. What China has been doing is tightening at the margins by announcing several measures to cool down the property market, to cool down the commodities market. And the Chinese government has also reduced the scale of its bonds issuances, which shows that the government is not going to spend as much. But remember, China learned hard lessons from the global financial crisis when it overstimulated the economy. And it had to do that then because the global economy, including domestic China, was going through a very difficult period. So it overstimulated, and as a result, it has had to deal with the after effects, the hangover of this overstimulation up till today. So when COVID happened last year in China, China was a lot more prudent in its stimulus measures. It didn't go overboard. It announced more targeted stimulus measures, and to me, that is good. So when we look at this chart and we look at the decline in the credit impulse and we look at declines in total social financing in China, it may seem like a negative in the nearer term, And that's also reflected in the performance of the China market so far. To me, I take it as a positive for the longer term sustainability of the Chinese economy, as well as for the Chinese stock market. So let us spend some time now talking about inflation. And on that note, let's move on to slide 10. Inflation has been a key topic for investors this year. We saw a sharp spike in inflation in April on a year-on-year basis, and we will likely see the same in May. So this is spooking investors a little bit. And why did we see the sharp spike? Because in April and May last year, if you recall, we were going through the worst of the economic lockdowns. So at that point in time, in those months, we saw prices declining very sharply. You looked at commodities prices. I'm sure most of you remember all futures even went to negative. And as we cycle through this base year effects this year, of course, prices year-on-year inflation would rise, right? But to the question, why do we focus so much attention on inflation? Why is inflation important? It is important because if inflation rises sharply and gets out of hand and remains sustainably high, that will have a negative impact on markets. Why is this so? Because investors would then expect interest rates to rise. They would expect central banks to start tapering and raising interest rates. And if interest rates rise too much, valuations of markets will come down, both for equities and for bonds. On the other hand, markets welcome some inflation. So gentle inflation is good, gradual is good. But currently, in the past few months and at present, markets have been spooked by the sharp rise in headline inflation numbers. As I said, this should not be unexpected. The increase is mechanical due to the low base effects from last year. So one of the more important questions we have to ask ourselves is whether this rise in inflation is structural or whether inflation will start to moderate as we move through the rest of the year. And on this point about whether inflation is structural or whether it's temporary, we are on the same page as the Federal Reserve. They've come out to say they think it's temporary. So if we are wrong, we can also blame the Federal Reserve. We expect that as we move into the second half of 2021 and into 2022, inflation numbers will come down. They will, of course, be higher than what it was pre-COVID and during the heights of COVID, but we think that the increase in inflation will be manageable. If you look at the chart above on the left, you can see the sharp spike in headline inflation in headline CPI. But what the lower panel shows is the so-called cleaner measures of inflation. And based on those cleaner measures, inflation does not seem to be as worrying. Core CPI has, of course, risen, but it is still manageable. And on the right-hand side, some of you would have read that wages have been rising and that employers are finding it hard to find employees. Let me try to explain this. Wages have been rising because the commonly used measure of wages, at least for news headlines, the commonly used measure of wages in the US is average hourly earnings. And during the pandemic, it was the blue collar or lower paid workers who lost their jobs. So mathematically, of course, average hourly earnings shows an increase as the lower paid people get removed from the calculation. But if you track another often used measure of wages, it's called the Atlanta wage measures, which is shown on the right-hand side. This Atlanta wage measure strips out the outliers and also uses the median wage to track. So in short, it is less noisy. And on this measure, it shows that wage increases are manageable. As to the point on difficulty in finding employees, again, especially in the blue collar segment, this segment of the population, they are getting cash handouts from the government. For those of you who may not be aware, jobless aid in the US is $400 a week. And with the American Rescue Plan that is currently in place, the jobless get an additional $300. So in total, you're getting $700, right? So for some people, I'm not saying all, but for some people, they have little incentive to get back to work. You are essentially getting paid more sitting at home than what you would be getting being employed in a blue-collar position. And also with school closures, mothers with young children find it difficult to go back to work. But progressively, this rescue plan would start to reduce beginning June. Some of the Republican states are already stopping this, but for the entire United States, I think it ends in September. So once that happens, I expect to see more people willing to get back into the workforce, because then the incentive is there, right? They probably earn more going back to work than sitting at home. Moving on to the next slide on inflation. This is an interesting chart because while we are all preoccupied with year-on-year increases in inflation, what this chart shows you is instead of year-on-year inflation, which definitely shows the effects of inflation catching up post-COVID, what we have here is 2-year inflation rather than the standard 1-year measure. In other words, how much higher are US prices today compared to 2 years ago? And as you can see, so far, it's around 1.7 to 2.2% price increases per year, which to me feels quite reasonable and should be supportive for equities markets. Moving on to slide 12, again on whether inflation is transitory or structural. What you can see here is that prices have clearly increased across the board. We have to acknowledge what happened. What happened is the pandemic threw production out of whack, and the subsequent recovery in demand was so strong, and it meant that supply cannot keep pace. Because as some of you who may be in the manufacturing industry or in business, you would know that it is not so simple to just switch things off and on and expect production to resume immediately. I believe that moving forward, some of these supply bottlenecks gets resolved, and therefore prices should also normalize. What we have been hearing as well, and some of you would have heard this too, if you are in manufacturing, especially in the technology sector, is that there is an element of double ordering due to the shortage, right? So manufacturers, because they're so fearful they're not going to get enough of their component supplies, they've been double ordering, and that only serves to perpetuate the price increases. So again, as supply normalizes, the orders should also normalize, and price gains should also normalize as people become less kiasu. So that's what I'm trying to show here in the chart on the right. As new orders start to normalize, we expect prices or price rises to also normalize, and we should start seeing that as the bottlenecks get resolved. So the key message from this chart here is that the large jump in prices mirrors both the severity of the pandemic-induced recession and the steepness of the subsequent recovery. And during this dramatic business cycle swings, which we rarely see, relative price shocks occur, and this causes the erratic moves in CPI inflation that we are seeing. So in our view, in conclusion, inflationary fears should subside, and the Federal Reserve can afford to sustain accommodative monetary policy that should keep growth at above trend pace and continue to support equity valuations. Moving on to the next slide, slide 13. Only time will tell if our view is correct, whether inflation is transitory or structural. And as I've shared, my view and the Fed's view is that this sharp increase in inflation is temporary and should taper off in the coming months. But in the longer term, beyond the next 1-2 years, it's too early to say. What I'm putting up here is just a chart to show you some of the opposing forces at play, which will determine whether inflation is structural or we revert to what we've been experiencing since the global financial crisis, which is a continued period of low inflation. So this is just for your information for you to look through. Anyway, this slide is just for your information. I was just sharing that our view is that inflation, we think inflation is temporary or transitory, but longer term, beyond the next 1 or 2 years, it's too early to tell. But what I'm putting up here is just for you to peruse. There are opposing views as to opposing forces at play as to whether inflation will be structural or whether we revert to what we've seen since the global financial crisis, which is a continued period of low inflation. So let's move on to the next slide, slide 14. One final point on inflation. One final point on inflation, I touched on this earlier. Employment has not fully recovered. Hence, sustained wage pressures is unlikely to rear its ugly head anytime soon. You can see in the US, employment is still way below what it was pre-COVID. In some of the other countries, it's recovered a little bit better. But I suppose we take our cue from what's happening in the US, because the Federal Reserve ultimately is what we call the central bank to the world and determines global liquidity. It's a large actor in determining global liquidity. Now let's move on. The second section, we'll touch on valuations, and I've just got one slide here. Now, there's no denying that valuations is above average. Above is a chart for the valuations chart for Asia ex-Japan markets based on PER, or price to earnings ratio. And as you can see, it's trading above its long-term average. And the same can be said for other financial markets as well. But we come back again to inflation and interest rates. If inflation is indeed transitory, and markets start to believe this, then valuations can remain higher for longer, especially against the backdrop of a continued economic recovery. Remember also that there are other methods of valuing companies. One widely used method is based on discounted cash flows, or net present value. And with this method, one of the key determinants is the risk-free rate, or simply put, it's the interest rate you use to discount the future cash flows of companies. And the lower the interest rate, the higher the theoretical or net present value of future cash flows, and vice versa. So if interest rates rise, the values or the theoretical values of these companies also decline. So if we believe, and if we are right, that interest rates remain well behaved, the valuations of the market can be supported. One more thing on valuations. Valuations is rarely a good timing tool for markets. More important to us, I mean, through my experience, it is more important if you're in it for the long haul. It's definitely much more important to invest in the right companies at reasonable valuations. You don't go silly investing in very, very expensive companies. As long as you adopt that reasonable approach, then over the long term, you will do fine. Finally, we move on to technicals. On technicals, we track a few data points. One of these is the bull-bear indicator. Currently, it is at 7, which is considered neutral, although it shows it's red, but it's considered neutral. We would prefer it lower, of course, but it is what it is. At the height of the pandemic last year, it went to 0 and stayed there for many weeks. And that showed at that point in time, everyone was bearish, and it was a good time to be contrarian to deploy money into the market. Currently at 7, and this goes back to what I said earlier, people have come back into the market. Investors have put money back into the market, and therefore we just have to be that little bit more circumspect or judicious in what we invest in, and don't invest blindly. And on to fund flows on slide 19. Okay, on fund flows, tying in with what I mentioned earlier about plentiful liquidity and liquidity having to find a home, there has been a lot of inflows into global equities this year. And definitely this pace of inflows cannot be sustained, but so long as there is no tapering and there is continued excess liquidity support, there will be opportunities in the markets, right? Markets may not rise very much in aggregate, but we still are confident that there's enough opportunities for us to explore that we can invest in. One other interesting point to highlight for equity flows, and this is shown in the bar charts on the right of this slide, is that year to date, much of the flows has gone into value funds. The red bar shows the excess of inflows into value funds versus growth funds. And it shows that this has almost fully reversed the excess of inflows into growth funds versus value funds that we saw last year. So if you look at 2020, the gray bar, it was minus 80 billion, I think. And this year, inflows into value funds has exceeded inflows into growth funds by almost 80 billion as well. Why is this so? Last year, due to the pandemic, central banks cut interest rates very aggressively. And back to what I mentioned about valuations, as interest rates were low, the theoretical value of growth stocks were higher. And remember also that these expensive growth stocks were beneficiaries of the lockdowns. Examples include Amazon, Facebook, Netflix, closer to home, Tencent, Sea, and cybersecurity companies as well. And all these reversed towards the last quarter of 2020 and this year as reopening took place and bond yields rose, which drew more and more inflows into the value strategies. The value strategies are the ones that benefit from the reopening or reflation theme. And these kind of funds are the ones that invest in commodities, they invest in materials and industrial companies, as well as banks and financials. Right? So in short, businesses that were so-called COVID losers reversed to being the winners this year, while the COVID winners have underperformed in the last 6 months. And to give you a sense of what's transpired, moving on to slide 20. Here's the performance for the US market, just to show the divergence in the performances of the different sectors. You can see this is up till April 2021. It's a bit dated, but it serves the purpose of explaining that the S&P 500 was up 11%. But if you look at the information technology sector, it was only up 1%, whereas the strong outperformers were the energy sector, which was up 40% as oil prices rose. The materials and the financial sector as well registered returns of above 20%. So this contrasts with what we saw in the technology or information technology sector, which was only up a measly 4% on a year-to-date basis. So this is the rotation that occurred, but moving forward, we'll share with you our strategy on why we continue to invest in some of these growth stocks. So let's move on to the final section on our strategy. This is our general view, our thoughts and strategy. The way I look at investing as a fund manager is that investing is all about assigning probabilities to various outcomes and adjusting your portfolio accordingly. In reality, of course, this is easier said than done because there are no certainties, but here's my attempt at it. Right. At the outset, I think markets should consolidate in the near term at the index level, as it is unlikely that we have good news which would surprise markets further. We will still have good news, but the key is expectations are also high. So it is unlikely that this good news would surprise markets further. But to my mind, in the shorter term at least, I think there could be some rotation within the market. And this time, unlike what we've seen in the earlier part of the year, where there was rotation from growth into cyclicals, I believe we should start to see some rotation back from cyclicals into growth. And given our views on excess liquidity and inflation, and with different parts of the economies opening up, I see enough investment opportunities to explore. For example, as vaccinations get rolled out, certain services sectors would benefit, such as travel, hospitality, and F&B. And if we are right that inflation is transitory, and this is very important for our strategy specifically, if we're right that this inflation is temporary and markets start to come around to that view, then we think the quality long-term growth stocks or the quality long-term compounders which have lagged the market, they will start to perform again. So a brief recap on what we have done. We had increased exposure to cyclicals and reopening plays, and lately also some defensive sectors because markets have done well. So we also just want to have some exposure to the more defensive sectors. But broadly speaking, we continue to be partial towards owning quality companies that have longer term growth prospects. As to us, these companies have better earnings visibility, and we also view investing as being owners of businesses rather than wanting to rent businesses. Right? We will consider adding some cyclicals at the right levels, as this is in line with our view of a continued global economic recovery. But we think that there are better price points for us to deploy money back into cyclicals, given what we're seeing in terms of, given what we're seeing in China's credit impulse, because China is a major consumer of commodities. And if the credit impulse continues to decline, we believe that commodities prices should also take a breather. And it is at that point we will reassess whether we want to increase our exposure to cyclicals. And finally, 3 points I want to mention here. First, while growth in the US is slowing down, we think the slowdown will be relatively benign as growth is slowing from exceptionally strong levels. Second, growth in many parts of the world is still speeding up, and different industries as well are also benefiting differently from reopening. And thirdly, we believe monetary policy will remain accommodative in the face of what is likely to be a transitory increase in inflation. I would like to end my talk on the next slide, moving on to slide 23. I think this is a very interesting slide. I know many investors who try to time the market. I have also often tried to time the market. Sometimes it works, sometimes it doesn't. And as professional managers, I can tell you, it is very difficult to time the markets these days as markets move so quickly. And for those of you who have an existing relationship or long-term existing relationship with Affin Hwang Asset Management, we have been actively trying to promote proper asset allocation and diversification to our investors. And for some category of investors, we have also been advocating for them to employ dollar cost averaging. Of course, what constitutes the right allocation for you is dependent on your own individual circumstances. But for those of you who are able, staying invested is the way to go as you benefit from what is commonly known as the eighth wonder of the world. And this eighth wonder of the world is called compounding. Right? Here's an illustration of an investor who has been so unlucky as to invest at exactly the worst possible moment every year. This guy invests $1,000 every year, and he's been doing that since 1969. But every day his luck is every year his luck is bad because he invests at exactly the peak of the market for that year. Right? But in spite of that, he has managed to turn, by staying invested, he has managed to turn that 52,000 investment into a portfolio that today is worth 1.5 million. How is that possible? It is possible because he stays invested and benefits from compounding. And in the overall scheme of things, the timing aspect was only a minor distractor to the overall performance of this investor. Another golden rule of investing that I've come across is to stay positive on stocks unless one thinks a recession is around the corner. Some of you who have heard me talk before would also know that seeing around the corner is not easy, of course. It's not easy to predict a recession with certainty, but I hope these are not my famous last words. I do not think a recession is around the corner. Right? Last year's recession was caused by the COVID pandemic. This is what is known as a exogenous shock, external shock. Most recessions are endogenous by nature, meaning that they result from growing imbalances that are usually exposed by tighter monetary policy, right? So we can debate, even internally, we are always debating the extent to which the global economy is plagued by imbalances of one form or another. But one thing is clear, monetary policy is unlikely to turn contractionary anytime soon because central banks still believe the recovery is fragile, right? So in this environment, positive returns can still be achieved. But as global growth momentum is likely to slow later this year, I think investors who are significantly overweight risk in terms of exposure to cyclicals or credit-sensitive sectors, I believe it is prudent to pare back some of this cyclical exposure. So with that, I end my part of the presentation and I hand it back to Sean to open up for Q&A.
All right, thank you, David. Thank you, David, for that talk. We do see some questions coming in. Thank you all for the questions, and I'll try to group the question into a few broad category. There is a few question on, I think David, just now you mentioned about the rotation from growth to cyclical or growth to value. So this question is with regards to the rotation from technology stocks. The question is about, I think we see a correction in the tech sectors over the last few months. So those questions will be relating to how do you value them? Do you think that they are overvalued in the current environment? And secondly, how would you position this technology portfolio in your portfolio? All right. So that's the first question with regards to technology sector.
Okay. Yeah, it is true that the technology stocks have declined in prices or been consolidating for a long time. I last looked at it, probably been consolidating or underperforming for the last 6 to 9 months, right? And why? As I mentioned earlier in my talk, rotation was at play as expectations of normalization gained momentum. Bond yields started to rise, and let me preface my answer by also saying within growth stocks category, I also segment it into two types of growth stocks. One is growth stocks and one is hyper growth stocks, right? So if you look at the performance of growth stocks in general, it was the hyper growth stocks which declined significantly, whereas the growth stocks were, flat or were consolidating, right? And coming back to the point about normalization gaining momentum, bond yields starting to rise, a lot of these hyper growth stocks may not be profitable or barely profitable, and they would only turn a profit few years or many years down the road, right? And therefore, a lot of these stocks were valued based on discounted cash flows because there's no earnings to speak of. You can't value them on price to earnings. And because a lot of these stocks are maybe software stocks, there's not a lot of assets. A lot of assets is intangible, so you can value them on price to book. So what the investment community and the analyst community relied upon as their valuation framework to value these stocks is to use discounted cash flows, right? Forecasting cash flows out into the future and discounting them at some discount rate. So the lower the interest rate that we saw last year, the higher the theoretical valuation that can be justified. And this, of course, reversed once COVID came under control. US Treasuries, which is the global risk-free rate, if memory serves me correct, declined to a low of 0.4%, and subsequently through the last months, increased to 1.7%. So you can imagine what happens, right? Interest rate, risk-free rate you used to discount these growth stocks was 0.4. Definitely you get much higher theoretical valuation. And as interest rates moved up, your fair value or theoretical fair value of the stocks comes down very significantly because it is very sensitive to your risk-free rate. Another point to highlight also is that some of these growth stocks were COVID winners. They benefited from the lockdowns, and this has reversed in the past months. And COVID losers are the ones that had done well, right? But going forward, in terms of our strategy, as I alluded to earlier, I'm still comfortable having good sized positions in structural long-term growth stocks. These would be the quality ones which have a strong moat, a strong business case or unique proposition, the ones that have strong cash flows and are profitable. So when I talk about us investing in growth stocks, it is this category of growth stocks that we invest in. Some may say that these are then the discovered names, but to me at this juncture, I prefer the certainty of earnings growth rather than having large exposures to hyper growth stocks. It doesn't mean I don't invest in hyper growth stocks. It just means that I just need to be more careful in managing my exposure limits to the hyper growth names. So in sum, we are still comfortable owning the growth stocks. And in our portfolio, we are still tilted towards having more growth stocks. Back to you, Sean.
Thanks, David. We can bring the question closer to home. There is about 3 to 4 questions with regards to Malaysia. Let me just read out the question on Malaysia. One is on the Malaysian banks and the NPLs, whether it will rise given our MCO3 lockdown. The second question on Malaysia is that when would the recovery of economy in Malaysia start? Is it after the vaccination effort? And there's another question of Malaysia on the trend of property market from now till, I don't know if you can look beyond the 5-10 years. So David or Pak Seng, you want to take this question on Malaysia?
Yeah, sure. For the banking sector, we are actually quite positive on the outlook, given that, yes, MCO 3.0 does cause a hiccup, and we do not rule out that there could be further hiccups moving forward. But the bigger picture remains unchanged, that we'll eventually reach a recovery scenario. And I think the next 2-3 months, the government has already guided that pickup in vaccinations will accelerate, particularly with the import of more vaccines. So net is actually very optimistic for the banking sector. And on top of that, in terms of NPLs, with the provisions provided by the banks, they've actually preempted the pickup in NPLs. So it shouldn't come as a surprise if NPL does pick up to the market. So for the moment, now market is actually starting to price in a recovery scenario. Okay, the next one in terms of property segment, I think since 2013 to 2014, the property market has been a downtrend due to supply-demand dynamics, probably excess supply in wrong markets, and probably also income levels and also prices of a lot of the properties. But what we saw is that first Q of 2021, despite partial MCO, we saw record high mortgage applications. So this is a very positive indication for the property market, even though with a lockdown and MCO with the COVID, supported due to the strong market performance over the last 1 year and also all-time low interest rates. I think it is very positive for the property market. And at the same time, a lot of property stocks are actually trading at less than 0.5 of their book value. So valuation is not a challenge. It's probably basically, I think the main challenge is actually for banks to actually approve these loan applications. So moving forward, when the economy does start to gain traction, I think there is potential for the property market to actually see some recovery, along with a lot of the recovery sectors, which we are quite optimistic in.
Okay, thank you, Pak Seng. Moving on, there is a few questions on the China A markets. Maybe this is a question for David. The question would be, can you share your view on the China market? And secondly, given the continuous rising tension between US and China, and what will happen, right, if this tension escalate to a higher level? Yeah, so view on China as well as the view on US-China tension.
Okay, on China, if we are referring specifically to the A-share market, personally, I think that it is time to start relooking closely at the A-share market. I shared earlier that the Chinese market has not been performing as well, has been a relative underperformer. And that's because, again, as I shared in one of the charts earlier, it's because a lot of investors look at the credit impulse of China in determining their top-down view on the Chinese market. To my mind, while I do not expect the Chinese government to start loosening anytime soon, to my mind, they are probably, we'll start to see in the coming quarters that the credit impulse, the decline in the credit impulse start to bottom up, because again, it's a base year effect. Right? And with that view in mind, I think we have to be early and start to look at ideas in the A-share market, which for our own strategies, we have started to do so. We have, in the last month or so, started increasing our exposure to some of the domestic China names. But in the shorter term, as I mentioned, given that still declining credit impulse, I think it is prudent to lighten up, if you have significant exposure, to lighten up on the credit sensitive sectors. So credit sensitive sectors, what are these? These are typically your commodities, your materials, property to a certain extent. Right? So that's how we're adapting to the macro environment. Enough opportunities, and our focus is on the consumption space. And looking out the next 6 months, I think we should start to see the credit impulse start to taper off. As to the question on geopolitics, obviously, if geopolitical tensions escalate sharply from here, be it US, China, be it because of Taiwan or US, Iran, there's so many pockets of potential flare-ups in geopolitical tensions. If it escalates to what is not expected, right, it really flares up, then clearly it will be negative for markets. What can the US do? We said before, last year, before the presidential elections, is that Biden is not going to go soft on on China, right? We have also shared that this anti-China sentiment cuts across both divides. It wasn't just a Republican sentiment, it's also the Democrats. So overall, Americans, it's this bipartisan feeling of trying to suppress China. But to me, as long as they remain pragmatic in that they acknowledge that both are huge actors in this economic economic globe that we exist in, then I don't think they will. It will flare up too significantly that to the detriment of their respective economies. There's also concerns about Taiwan, US stance on Taiwan. That again is a potential risk. But at heart, I believe that both sides would be very practical. I don't think it will escalate such that they start lobbing missiles or start sending battleships in. That's not our base case. But again, nothing is impossible, but I think it is not probable. The other point to highlight about geopolitical tensions is, as per what we've mentioned in the past, is that Biden's approach would be to try to corral support from its allies, unlike Trump, who just goes it alone. This is potentially another risk if he's able to get all the allies to gang up and group together and gang up against China and impose tariffs or restrictions. But again, I don't think that is the case. Australia is one that has been tagging on to what the US is saying, but you can see clearly New Zealand is adopting a different approach. Within Europe, I think Germany is also a lot more hesitant in just following blindly the US lead. So base case is, well, he will try to get that support. I don't think some of the other allies are going to just blindly follow whatever the US does.
All right. Thanks, David. Maybe we can shift the question to Pak Sing. There's a couple more questions. One is on this is probably a little bit difficult, but what is your year-end target for FPM KLCI? And second question on Malaysia would be, is Malaysia still favorable to the foreign investors, given the close competition from neighboring countries like Indonesia? Your thoughts, Pak Sing?
For FBM KLCI target, I mean, even if I give a number, I'll definitely be wrong. I think it doesn't really, it's basically a guessing game. I mean, market does have, it's a wide range in terms of levels, but I think a lot depend on our vaccination progress and also the government policy and how fast the economy recovers. But I think expectation is with the MCO 3.0, GDP growth will likely be on the lower end of Bank Negara's estimate. So likely, but for now, the market is starting to price in a recovery scenario. So I think I can be quite confident to say that we'll probably be at higher levels at the end of the year. But in terms of levels, I'm unable to give you an exact number. So what's the second question?
Malaysia receiving foreign investment given competition from neighboring countries?
Okay. In terms of attractiveness of Malaysia, I think in the context of foreigners, we've seen net outflows from foreign investors for the past few years. I think foreign positioning in Malaysia equity markets about 20%, largely due to several key factors: political uncertainty, uninspiring corporate and economic outlook, and also probably some part due to our fiscal position. But in terms of foreign direct investment into Malaysia, there we do see some pockets in Malaysia, particularly in the technology and manufacturing sector. Malaysia does have the infrastructure for actually as a beneficiary to the trade diversion angle. And we do have the skill set as well. So a lot of the companies which primarily in exports are getting new customers, particularly from foreign overseas. So it's not a blanket assumption, but it's actually a certain pockets which we've identified in Malaysia.
All right, Pak Singh, thank you. David, next question. There are a couple of questions, 3-4 questions on cryptocurrency. What is your view on crypto? And one of the questions read, is cryptocurrency the new gold? David, your thoughts?
A tough question, but it's a very popular question these days, given how cryptocurrencies, Bitcoin, Dogecoin have performed. First of all, given that I'm here, giving a market outlook talk tells you that I did not put all my life savings into Bitcoin. So I admit to being a bit of a dinosaur, right? I'm not really a believer in crypto, but so far I've been proven wrong. Of course, there are arguments on both sides. One can argue that crypto is a bit like gold. But bear in mind that there's only one goal, right? Whereas cryptocurrencies, there are so many different types of cryptocurrencies now, and more will follow. Right? But leaving that aside, as to why it could be a bit like gold, it's because it's built on a collective belief about its value. Right? Gold, cryptocurrencies, these are not income-producing assets. So there is no intrinsic value. It's not like you can see the cash flows and you can discount it back to arrive at some fair value. So its value is, to put it simply, its value is based on what people believe its value should be. So there's an element of game theory, or what we call Keynesian beauty contest involved, right? And human behavior is such that people are often able to act tacitly in concert if they know that others are trying to do the same. So if you, me, and everyone else on this call starts to think that Bitcoin is going to rise in price to 1 million in the next 3 weeks, collectively, although we are not colluding officially, collectively, there will be buying pressure, and you will see it self-fulfilling in that sense, right? So yes, it is a little bit like gold in the sense, similar to art, a nice Picasso painting. Also, there's no intrinsic value in the sense that you can't discount cash flows, there's no earnings, but because certain people appreciate art and people think it's going to be this value or the value is going to increase, that's why people buy art. So you can say the same about cryptocurrencies or Bitcoin. Slight difference though is that gold does have some practical usage, right? You can use gold for your filling, for your crown, right? Or in some industrial uses. Right? On a fundamental basis though, and this is me showing my dinosaur mindset perhaps, on a fundamental basis, is Bitcoin or other cryptocurrencies money? The answer is no. For something to be money, this is what I learned in school, for something to be considered money, it must have 3 properties. The first is it must be a medium of exchange. Second, it must be a unit of account. So a medium of exchange means, let's say you want to go out to buy a Proton X50, you offer the salesman cryptocurrencies and he'll accept it. So it's a medium of exchange. Second quality or second property is unit of account. So you go to your Proton dealer and you ask him, how much is a Proton X50? And he tells you it's 2 Bitcoins, unit of account. And in both those instances, cryptocurrencies do not meet the requirements. So the first 2, as I said, medium of exchange. Second property is unit of account. The third one is store of value. And arguably, cryptocurrency, one can say that it could be a store of value, but not the other 2. Some crypto believers believe that I am putting the cart before the horse, because we can say that you can argue justifiably that the first 2 properties would be the result that follows once crypto gains wide acceptance. So if everybody starts accept Bitcoins or crypto, then it becomes a medium of exchange. then it becomes a unit of account. But at this point in time, that is not the case. So having said all this, just one more thing to add. One other fundamental issue with cryptocurrencies, though, is that governments don't like it. Right? It is a threat to economic sovereignty of economies, of countries. It undermines state influence over the economy and society. And you would also be reading that various central banks and countries are also coming up with their own digital currencies. But then again, just because something undermines the sovereignty of a state does not mean that it cannot be valuable. So I don't really have an answer whether it's yes or no, but if yes for you, then don't put all your eggs in that one basket. I'm not sure whether I answered the question, but those are my thoughts on crypto.
Thanks for your view. It's 12:07 now. I think we'll take one last question, and I'll try to. There is 2 to 3 questions on. Earlier, David, you mentioned about long-term structural growth stocks, and some of these questions would be: could you define what would you consider a long-term structural growth stocks, and perhaps give an example of these? And then I think tying into that question will be what are example of stocks that could do well in this rising inflation environment? Yeah, so maybe one last question, and I know there's a lot of questions coming in. Thank you all for the question. We'll try to reach out to you variously through your account manager to try to answer some of those questions. David, those questions, go ahead.
Okay, some of the key characteristics of stocks which we would consider as, which we would classify as long-term structural growth stocks would be, you can see a long runway for their growth, right? So that contrasts with a cyclical stock. Let's say if you were to invest in an energy stock, you are hostage to the ups and downs of the economic cycle, to oil prices. Whereas for the long-term structural growth stocks that we like, of course, ultimately everything is subject to a certain extent to the macroeconomic cycle. But there are companies out there which have a lot of self-help. They, a lot of factors are within their control. They're not hostage to the external environment as much. So companies which have that quality, that property of earnings visibility over the long term, companies that have, we like companies who do not have to have that certainty of revenues. So these kind of companies you typically find in subscription-based models. So companies which produce a product or a service or software where every year, at the margin subject to economic cycles, but every year they get repeat subscriptions. One case in point would be Microsoft, right? And in addition to those two factors, these companies have very strong cash flows. They generate very strong return on shareholders' funds, because as you appreciate, these companies, they invest a lot in R&D, but they're not bogged down by physical assets. So the margins they earn, the returns on capital that they earn is significantly higher than your typical brick and mortar company. Some of the other structural growth companies are the ones that we like would be those that play into a theme that we see expanding as demographics change or as consumer behavior changes. An example would be Airbnb, right? Airbnb, of course, is trading on expensive valuations, but we think the growth runway for companies such as Airbnb, as consumer behavior changes, as people maybe prefer to live in an Airbnb lodging as opposed to a big hotel, starts to increase. We think there's an opportunity there. I'm not saying go out and buy these stocks. These are just examples of stocks that we like.
All right, thank you, David. All right, that concludes our talk for today. I thank you for your time, for dialing in. Thank you, David. Thank you, Pak Seng. Hopefully we'll be able to reach out to all of you with regards to the questions that's not answered. All right, meanwhile, have a good lunch and stay safe. Thank you so much.
Thank you. Bye.